Level 1. Negative balance. Your bank account is below zero. Maybe by $12, maybe by $80, maybe by $400. The number almost does not matter, because once your account goes negative, the system does not ask why. It does not ask if your paycheck came late. It does not ask if your rent hit early. It does not ask if that $47 charge was a subscription you forgot to cancel. It just responds. The overdraft fee hits. The card declines. The gas station line is behind you. You try again. Declined again. And now you are standing there doing math in your head while everybody behind you is waiting. That is what financial stress actually feels like. Not dramatic, not cinematic, just your card declining while you are trying to figure out how money disappeared before the month ended. At this level, the bank does not see you as a relationship. It sees a negative balance. That is it. You are not getting premium credit cards here. You are not getting high limit approvals here. You are not getting personal loans with good rates here. You are not getting let me see what we can do for you. You are getting automation. A fee. A decline. A warning email. A reminder that the system is not built to be emotional. And this is where credit problems usually begin. Because when your checking account is negative, what happens next? You start using credit cards to survive. Then utilization goes up. Then the card gets maxed out. Then you miss one payment. Then one late payment becomes 30 days. Then 60. Then 90. Then the account charges off. Then it goes to collections. And now the problem is no longer just your bank account. Now it is your credit report. And once it hits your credit report, every bank you deal with after that sees the damage. Level 2. Low balance. You are not negative anymore. That is progress. But barely. You have $200 in the account. Sometimes $500. Maybe $700 for a few days before rent pulls it back down. You are no longer drowning, but you are still not floating. You are in that category where the bank services you but does not really value you. The monthly maintenance fee hits. $12, $15, maybe more. And the rule is simple. If you kept a higher average balance, the fee would disappear. But because you do not have that balance, the fee stays. So the person with less money pays to have the account, and the person with more money gets the account for free. That is banking. At this level, your savings account pays almost nothing. Your checking account gives you no real benefit. The app works. The debit card works. The teller is polite. But there is no relationship. There is just a transaction. And when you try to apply for credit, the bank does not offer you premium products. It offers you a secured card, which means you give the bank your money first, then they give you a credit limit based on the money you already gave them. It sounds ridiculous when you say it slowly, but this is how people rebuild from the bottom. And if your credit is damaged, this may be where you have to start. But here's the problem. A secured card helps build credit. It does not automatically fix bad credit. If you still have collections sitting on your report, if you still have charge-offs reporting every month, if you still have late payments, if you still have unauthorized hard inquiries, if your utilization is still high, then one secured card alone will not change how banks see you. You need both. You need positive accounts, and you need negative items reviewed. Because the bank is not just looking at what you opened today, it is looking at the whole file. Level 3. Stable income. Something changes, not dramatically, but enough for the bank to notice. Your direct deposit starts hitting consistently. Every 2 weeks. Same employer. Same pattern. Same account. You did not get a phone call. Nobody congratulated you, but the system noticed. Your account no longer looks random. It looks predictable. And banks love predictable. Now the offers begin. Not amazing offers, but real offers. Credit cards with actual limits. Maybe $1,500, maybe $3,000, maybe $5,000. The interest rate is still high because the bank is still pricing risk. But the door is open now. 6 months ago, the bank had nothing for you. Now it is showing you banners in the app. Pre-qualified. See your offer. Apply today. And for the first time, banking starts working the way people say banking is supposed to work. You apply. They review. You get approved. But here is where people make the mistake. They think approval means they made it. No, approval is not the goal. Good terms are the goal. Because there is a difference between being approved and being respected. Bad credit gets approved sometimes. But bad credit gets approved expensively. High APR, low limit, more conditions, more money down, less flexibility. So if you are at this level, your job is not to start applying everywhere. Your job is to clean the file before the next application. Pull Experian, pull TransUnion, pull Equifax. Look for what is still hurting you. Collections, charge-offs, late payments, hard inquiries, old addresses, wrong balances, duplicate accounts, accounts reporting differently across bureaus. If something is inaccurate, outdated, duplicated, unverifiable, or not yours, it needs to be challenged. Because every negative item tells the bank one thing: risk. And risk is expensive. Level 4. Growing savings. Now you are not just earning, you are keeping. That is different. The savings account has real money in it. Maybe $10,000, maybe $18,000, maybe more. Your credit card gets paid in full every month. The interest rate does not matter because you never carry a balance. Your utilization is low. Your payments are on time. Your report is cleaner than it used to be. And now the bank treats you differently. Credit limit increases start showing up without you asking. One day your limit is $3,000, then $7,500, then $12,000. Not because the bank became generous, because your profile changed. You are no longer showing stress, you are showing control. You pay on time, you do not max out. You keep money in the account. You look safer. And when you look safer, the price of money goes down. The car loan rate gets better. The credit card limit gets higher. The personal loan offer gets cleaner. The mortgage conversation gets easier. This is where people start feeling the system tilt in their favor, not because they are rich yet, but because the bank's risk model is starting to trust them. And this is where credit repair can create a real difference. Because if your income is stable and your savings are growing, but your credit score is still stuck, there is probably something on the report holding you down. A collection that should not be there. A charge-off still updating. A late payment reporting wrong. A hard inquiry you did not authorize. A balance reporting incorrectly. A duplicate account. Something, and that one thing can keep you in a lower tier. Same income, same savings, same bank, but worse credit file. Worse treatment. That is why you do not just save money. You clean the report too. Level 5. High savings and assets. Now your combined assets are getting serious. Savings, investments, retirement accounts. Maybe $100,000. Maybe $150,000. Maybe more. You are not ultra wealthy. But to a regular retail bank, you are no longer invisible. The phone line changes. The wait time gets shorter. The person answering has more authority. Fees get waived faster. Problems get solved faster. Pre-approved offers get better. Premium credit cards start making sense. Mortgage pre-qualification becomes easier. The bank is no longer just servicing your current account. It is thinking about your future business, your next home, your next car, your next investment account, your next credit card, your next loan. At this level, the bank wants to keep you, and that gives you leverage. But remember this: assets help, income helps, savings help, but credit still matters. You can have money and still get bad terms if your report is damaged. Banks do not only look at how much you have, they look at how you manage obligations. Did you pay on time? Did accounts charge off? Are there collections? Did you default? Did you overuse credit? Are you applying everywhere? Is your report clean? Because wealth with messy credit is still messy. it just has more money around it. So if you are trying to move into this level, do not ignore the credit side. Keep utilization low, pay everything on time, do not apply for unnecessary credit, remove or correct inaccurate negative items, and build a file that matches the life you are trying to qualify for. Level 6. High net worth. At this level, the bank stops acting like a place you visit. It becomes a service. Wealth management enters the conversation. Investment planning, tax coordination, estate planning, private client support. The conversation changes. You are no longer being sold basic products. You are being consulted. Someone asks about your goals, your timeline, your family, your risk, your plans. Not because the bank suddenly became kind, because your financial life is now valuable enough to manage. Loan approvals move faster. Paperwork becomes lighter. Rates become better. Problems get handled by people with authority. No long hold times. No repeated explanations. No let me escalate this. The experience changes because your value to the institution changed. And this is the part people do not like hearing. Banks do not treat everyone the same. They treat risk differently. They treat value differently. They treat clean profiles differently. And credit is one of the fastest ways they decide what category you belong to. A 520 score and a 760 score do not walk into the bank the same way. A report full of collections and a report with clean payment history do not get treated the same. A person with maxed out cards and a person using 3% utilization do not look the same. The bank may smile at both people, but the offers will tell the truth. Level 7. Very high net worth. Now, the products are not always public. The rates are not always posted. The access is not always available online. The bank begins offering things most customers never see. Special mortgage pricing, private investment access, dedicated teams, custom lending, priority processing, relationship-based exceptions. This is where the rules begin to feel flexible, not because laws disappear, but because internal policies have discretion. And discretion usually favors the accounts that make the bank the most money. A lower tier customer asks for a fee waiver and gets a script. A high-value client asks, and the fee disappears. A lower tier customer waits weeks for a decision. A high-value client gets a call. A lower tier customer gets denied by the system. A high-value client gets reviewed by a person. Same building, different bank. And that is the lesson. The higher you move financially, the more human the system becomes. At the bottom, everything is automated. At the top, everything is relationship-based. And credit is one of the bridges between those worlds. Level 8. Private banking. At this level, you are not just a customer. You are a relationship. Your banker knows your name, your family, your businesses, your goals, your foundation, your estate plan. Your private banker does not manage thousands of people. They manage a small group of valuable relationships. The loans are custom, the rates are negotiated, the paperwork is handled internally. The exceptions happen before you even know there was a rule. Again, banks are not breaking laws. They are using every legal degree of flexibility available to keep the relationship. That is power. And most people will never experience it because most people never build the profile that earns it. But here's the important part. You do not need to be ultra wealthy to start moving up the banking ladder. You start with the basics. Stop overdrafting. Build savings. Get direct deposit stable. Use credit correctly. Keep utilization low. Pay on time. Build positive accounts. Remove inaccurate negative items. Stop applying blindly. And make your credit report look like someone banks can trust. Because every level is a signal. Negative balance signals stress. Low balance signals limited value. Stable income signals reliability. Growing savings signals control. Clean credit signals lower risk. High assets signal value. And when those signals stack together, the bank changes how it treats you. So if you feel like banks always give you the worst terms, if you keep getting denied, if your credit card limits are low, if car dealers ask for huge down payments, if mortgage lenders say your score is not ready, if business funding keeps coming back with bad offers, the problem might not be the bank. The problem might be the file you are bringing to the bank. Collections, charge-offs, late payments, repos, hard inquiries, high utilization, wrong personal information, duplicate accounts, old accounts reporting incorrectly. Those things keep you in the lower levels. And the lower levels are expensive. That is why credit repair matters. Not because a credit score makes you rich, but because bad credit keeps you paying poor person prices, higher interest, higher deposits, higher down payments, lower limits, more denials, less flexibility, less access. And when you fix the credit report, you are not just chasing a number, you are changing how banks see you. That is the real game. Better credit does not automatically make you wealthy, but it can stop banks from treating you like you are broke. And once banks stop pricing you like risk, more of your money stays in your hands. More money in your hands means more savings. More savings means more leverage. More leverage means better options. And better options are how people move up levels. So the goal is simple. Do not stay at the level where the bank profits from your mistakes. Move to the level where the bank competes for your business. And if your credit report is the reason you cannot move up, fix the file first.